Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to customer payment terms and discount policy. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 732 Customer Payment Terms and Discount tab in the Practice Problems section. Closing this back out, we're going to have our information up top. We'll use that to work through the practice problems. We will have two scenarios that we will be working through. The first will be our base scenario. Then we will move away from the base scenario, focusing in on a cash discount and what the effect of the cash discount will be on our accounts receivable turnover. And then in future presentations, we'll do a similar kind of scenario, figuring more of the decision-making process as to whether or not we would want to have the cash discount and how to make that decision. So our starting point is we're going to assume that we have credit sales of $680,000. We make sales on credit. These are sales on credit, meaning they're going to be going through accounts receivable. When we make the sale, we sell it on account. They go through accounts receivable. We have to then collect on them in the future. The payment terms are 60 days, meaning we expect to be paid within 60 days before it is late and before we might take other actions such as penalties or collection action after that point in time. The average collection period then we're going to assume is 60 days, meaning we assume then the people that are paying us, our customers, are going to wait till the end of the collection period, 60 days, to pay us. Now, this will often be the case if we're dealing with other businesses, meaning if we're a business-to-business company, we sell to other businesses. Our clients are other businesses. They will be managing their cash management. And remember, when we think about cash management from a business perspective, we're always trying to basically receive money sooner if we can, all else being equal, and we're always trying to hold on to the money as long as we can before we have to pay it in our cash management strategy. Therefore, if we're selling to other businesses and they're conducting their cash management, they will most likely try to hold on to their money as long as they can, which means they will wait till the end of our payment terms before they pay us. Obviously, on our side of things, we would like to get paid sooner with regards to our cash management because we're on the receivable side of things. We would like to get paid within the 60-day time period, even though our terms give a 60-day period in which to pay before we take any further actions such as penalties or collection. So we'll start here and then we'll go on to, well, how can we incentivize getting paid sooner, which of course will be the cash discount. So then we have the average. So we want to then think about what our accounts receivable turnover calculation will be. What's going to be our accounts receivable turnover? Now, to do that, we're first going to think about what our basically average accounts receivable will be. Now, to think about the average accounts receivable based on these credit sales, we can then say, okay, we have the average collection period. How can I use that to calculate basically the average accounts receivable? Now, remember, the accounts receivable is something that's on the financial statements, and we're using basically a collection period in order to do that. The average collection period is usually something we calculate from the financial statements. We don't usually look at the financial statements and then try to calculate accounts receivable. Accounts receivable is on the financial statements. So now we're projecting into the future, we're doing a projection type of process. And whenever we're doing that to try to figure something out that's on the financial statements, we don't typically need to remember a new formula. We just could use this formula for the average collection period to then back into the unknown, that being the accounts receivable related to these credit sales. So let's do that. We're going to say, okay, the average collection period is typically calculated as accounts receivable divided by average daily sales. So the accounts receivable then is the unknown. That's why it's yellow, even though there's a number there. So that would be our unknown. Average daily credit sales would then have a sub-calculation. That would be the credit sales of the $680,000. And then we're going to divide that by the 360 days, the number of days in a year, which is closer to 365. But we're going to assume nice even months of 30-day months. So 30 days times 12 would give us that 360. And that'll give us that 1,889 about. So let's do that in the calculator just so we can see the rounding related to it. So we got 680,000 sales for the year, 360 days in the year about. If we round, we get about 1,889 with regards to the average daily sales. And then the average collection period is known now. That was 60. So the average collection period is 60. So if the yellow item was unknown, we would say X, if we wrote this out algebraically, X divided by the 1889 about would equal 60. And then we could solve for the unknown, or X, in that case. So if we were to do that, we take the 1889 divided by 60. Again, there's rounding about. Let's do that one more time. The 1889 times 60 is going to give us about the 113,340. Again, there's rounding involved here because this number is actually 1888 point something. And then if we were to double check that, we'd get the 113,333 divided by about 1889, and we get about 60 there. So that's going to be our calculation. That helps us to back in then to the accounts receivable related to these sales. So the accounts receivable being the 113,333. Once we have that, then we can calculate our accounts receivable turnover. But before we do that, I just want to think about the fact that if we had this information, you might see the answer if we were to solve for the accounts receivable by basically rewriting the algebra. So you might have someone present, the answer to you and say, well, you'd have to solve accounts receivable this way. And note, again, this way is just simply us doing the algebra, reworking the algebra. You don't typically need to memorize the accounts receivable calculation because this is an item on the balance sheet. It would be easier if you already know the average collection period formula to plug the information into that formula, then look for the unknown. But if you were to see it recalculated this way, it would just be the average collection period being 60. Then we can calculate the average daily sales, which once again is the 680,000 credit sales divided by the 360 to give us the 1889 average daily credit sales. And then we can take the 60 times the 1889 about, which gives us about 113,333. Now, once we have that, we can then figure out our accounts receivable turnover. Accounts receivable turnover to see how efficiently we're turning over the receivables. So we're going to take the credit sales. That calculation is the credit sales of the 680,000 given to us here. That's how many credit sales we have. We're going to divide by the accounts receivable, which is going to be the 113,333. Again, notice there's rounding involved here, and we get about 6. So 680,000 divided by about 113,333 gives us about 6. So that's going to be our starting point. Now, of course, if what we want to do is we want to increase the receivable turnover. We would like to increase the turnover, which would represent the fact that we're collecting faster. So one way we might think to do that is to say, well, how could we incentivize someone to pay us sooner? Well, we can give them a discount. So we could say, hey, look, the terms are still going to be 60 days. You pay us basically within 60 days, but now we're going to give you a discount of 3% if you pay us within 15 days. Now, if you're doing business-to-business customers, notice again on their cash management side, even though this 3%, when you're thinking about normal sales from like if you went in a discount store and they gave you 3%, you'd be like, what? That's a pretty small sale, oftentimes. But when you're thinking about discounts from a business-to-business kind of situation, and you're dealing with companies that are simply waiting till the end of the time period to pay you, because that's the best cash management strategy and does have an impact when you think about multiple transactions over time, especially bulk transactions, then all you have to do is have a fairly small discount to negate them basically waiting till the end of the time period to take advantage of the time value of money. So if you're dealing with business-to-business clients, just to get paid sooner, a fairly small discount could result in being paid a lot sooner. So if we were to say, okay, we have terms of 60 days, we'll allow you to pay us within 60 days before we take collection action or before we charge you a penalty. But if you pay us within 15 days, then we'll give you the discount. Now, if we do this, we're going to assume that if we have business-to-business customers, they will no longer wait the 60 days, but will pay us within the 15 days because the only reason they're waiting 60 days is because of the cash management strategy to try to hold on to the money as long as they can. So we're going to assume that they pay us sooner, and that will make our accounts receivable turnover ratio much better. However, of course, we're going to need more consideration to determine whether or not this is a good policy, and we'll do that in a future problem, because obviously we will then have to, we're going to get less money on the discount that on the sales that we're going to have in terms of actual cash in order to get paid sooner. So we're going to have to think about how we're going to use that freed up cash. Is it worthwhile, the use of that cash, worth us collecting 3% less money? We can also think about how high the discount has to be in order to get paid sooner with regards to the cash collection. And we also want to think about what the term should be for the discount, 15 days or 10 days or something like that. And we can also think about whether we're actually going to increase sales with regards to a discount, because if we give a 3% discount, we've basically decreased the sales price. And you'd think, well, maybe we'll have an increase in sales given the fact that in essence the sales price is lower by the amount of the discount if they pay within that time period, which we're assuming if it's a business to business customers, they will. All right, so first let's just think about what's going to change with regards to our turnover, what we assume to happen. So we want to calculate, once again, the average collection period. So let's calculate the average collection period again, or use the average collection period to calculate the accounts receivable. So we're looking for the accounts receivable using the average collection period, which we're assuming now is 15 days, because everybody's going to be paying us within the discount time period to take advantage of the discount. That would be the accounts receivable, the unknown, that's why it's yellow, divided by the average daily sales, which is the 680,000 divided by 360, or once again, that 118 that we have here. So now we have X, we've got X divided by the 1889 about gives us what we now assume to be 15 as opposed to 60, because we expect everyone to be paying us within the discount time period. So then if we were to solve for that, we would take the 1889 about times 15. That would give us about the 28,355. If we want to double check that, we could take the 28,333 about divided by the 1889 about gives us about 15. So that's going to be our average collection. That allows us to back into the accounts receivable. Now, again, we could calculate this, and if you were to ask someone, they could say, hey, the calculation for accounts receivable would then be this. But remember, you don't want to memorize this accounts receivable calculation necessarily. You just want to know that all they're doing is reworking the algebra for the average collection period, which you already have to know because that would be something that you would typically be calculating on the financial statement. So anytime you're calculating something that is a projected financial statement number, you don't really learn another formula. You try to figure out what ratio would apply to it and then do the algebra. So if we were to rework it, though, we would take the average collection period, and then we have the average daily sales, which is the credit sales of the 680 divided by the days in a year, which is about 360 if we assume 30-day months. And that'll give us the 1889. 15 times the 1189 about gives us about, once again, the 28,333 for the accounts receivable. Now we can calculate the turnover to see what the improvement on the turnover would be. So we're going to say the sales are that 680,000. And now the accounts receivable is the 28,333. If we divide that out, we get 24 here. So now we've got the 680,000 divided by the 28,333, and that's going to give us the 24 in terms of the turnover. 24 in terms of a turnover means we're turning over a whole lot more than the 6 that we had before. So we've increased our turnover a lot, which is the purpose of the discount, which is what we would expect to happen if we have business-to-business clients and they're only paying us at the end of the term due to the fact that they're doing their cash management strategy. So that's great. We've achieved that. But now the question is, well, is that increase in the turnover worth it? And that's what we'll take a look at in the future presentations, because again, we're collecting less money, so we have to be doing something with that money, getting a return on the added cash flow in order to make it worth it, either paying off debt earlier, or we're putting it into an investment in order to get a return on it. And we can also consider, again, whether or not the sales would actually increase with regards to the change in the discount policy, as well as how many days we should have the discount policy and how high should the discount be in order to just incentivize people to switch over their cash management to paying us within the discount time period.